Beta is not what you think. It is not a measure of systemic risk, but rather the luck you cannot diversify away. In this analysis, we will show why beta fails as a risk measure, using evidence from Blume's research and Fama-French's factor models. The Capital Asset Pricing Model, or CAPM, tells us that beta measures a stock's sensitivity to the overall market. It is supposed to be the price of systemic risk, the risk that cannot be diversified away. Under CAPM, a stock with a beta of 1.2 should move 20% more than the market, and investors should be compensated for that extra risk. But is that really true? Let's look at the evidence. CAPM assumes that beta captures all relevant risk, but this assumption has been challenged. The model predicts a linear relationship between beta and expected returns, but empirical studies have found that this relationship is weak or even flat. For example, low beta stocks have historically outperformed high beta stocks on a risk-adjusted basis, contradicting CAPM's predictions. This suggests that beta may not be the right measure of risk, and that other factors play a more significant role in determining returns. Decades of research have shown that beta has almost no power to explain stock returns. In fact, the R-squared, a statistical measure of how much of the variation in returns is explained by beta, is typically between 2% and 5%. That means beta explains almost nothing. The Fama-French 5-factor model, which adds size, value, profitability, and investment factors, does a much better job. So why do we still talk about beta? The persistence of beta in finance is partly due to its simplicity and historical prominence. However, the empirical evidence is clear: beta is a poor predictor of returns. The Fama-French model, for instance, can explain a significant portion of the cross-section of stock returns, whereas beta alone cannot. This has led many academics and practitioners to question the usefulness of beta in modern portfolio theory. Beta is typically estimated by regressing a stock's returns on the market's returns. The formula is the covariance of the stock's returns with the market's returns, divided by the variance of the market's returns. This gives us a slope that measures sensitivity. But this estimate is far from precise. The estimation process relies on historical data, which may not be representative of future relationships. Moreover, the choice of the market proxy, e.g. S&P 500, and the time period can significantly affect the estimated beta. For example, using daily returns versus monthly returns can yield different betas. Additionally, the regression assumes a linear relationship, which may not hold in reality. These issues contribute to the imprecision of beta estimates, making them unreliable for investment decisions. One of the most damaging findings is that beta is not stable over time. Blume's 1975 study showed that high beta stocks tend to have lower betas in the future, and low beta stocks tend to have higher betas. This is called regression to the mean. It means that using the past 60 months of data to estimate beta gives you almost no information about the next 12 months. In other words, beta is a moving target. This instability arises because beta is influenced by firm-specific events and changing market conditions. For instance, a company that experiences a surge in volatility due to a merger or a regulatory change may see its beta spike, but this may not persist. As a result, any investment strategy that relies on beta is inherently fragile, as the beta you estimate today may not hold tomorrow. Because beta is estimated from noisy data, the confidence interval around it is huge. A typical 95% confidence interval might be plus or minus 0.5. So if you estimate a beta of 1.2, the true value could be anywhere from 0.7 to 1.7. That's a massive range. Making investment decisions based on such an imprecise number is like rolling dice. The wide confidence interval reflects the uncertainty in the estimate, which is often overlooked in practice. Investors may treat a beta of 1.2 as a precise measure, but in reality, it is just a point estimate with considerable error. This imprecision can lead to mispricing of risk and suboptimal portfolio construction. For example, if you think you are taking on moderate risk but the true beta is 1.7, you are actually taking on much more risk than intended. Let's make this concrete. Suppose you estimate a stock's beta to be 1.2. The 95% confidence interval is 0.7 to 1.7. That means the stock could be a defensive stock, moving less than the market, or an aggressive stock, moving much more. If you use this beta to size your position, you could be taking on far more or far less risk than you intended. This is not a theoretical issue, it's a practical one. For instance, consider a portfolio manager who uses beta to determine how much of a stock to hold. If the true beta is 0.7, the stock is less risky than expected, and the manager might be underweighting it. Conversely, if the true beta is 1.7, the manager is taking on excessive risk. This uncertainty can lead to significant deviations from the intended risk profile, potentially causing losses or missed opportunities. If beta is so unstable and imprecise, what does it actually capture? In many cases, a high beta is simply the result of a stock's recent volatility, which could be driven by company-specific news, not systemic risk. That volatility is often luck, a drug trial outcome, a lawsuit, a product launch. So when you use beta, you're often pricing in luck, not risk. This is why we call beta the un-diversifiable luck. For example, a biotech company might have a high beta because its stock price swings wildly on clinical trial results. These swings are idiosyncratic and not related to market movements. Yet, beta captures this volatility as if it were systemic risk. This mischaracterization can lead investors to demand a risk premium for what is essentially luck, distorting asset prices and capital allocation. Instead of asking what is this stock's beta, modern finance asks what is this stock's exposure to value, momentum, and quality factors. Factor exposure is more stable and more informative. It tells you not just how the stock moves with the market, but why it moves. This is the shift that Fama-French and others have championed. Factor models decompose returns into systematic factors that have economic rationale. For example, value stocks, low price to book, have historically earned higher returns, and momentum stocks, recent winners, also tend to outperform. By understanding a stock's factor exposures, investors can better assess its risk and return characteristics. This approach is more robust than relying on a single beta, as it captures multiple dimensions of risk. The Fama-French 5-factor model expresses a stock's expected return as a function of its exposure to 5 factors: market, size, value, profitability, and investment. Each factor has its own beta, or loading. This model explains much more of the variation in returns than a single market beta. For instance, the model can account for the size effect, small cap stocks outperforming large cap, and the value effect, high book-to-market stocks outperforming low. By including these factors, the model provides a more comprehensive picture of what drives returns. This is why it has become a standard tool in academic research and is increasingly used in practice. Investors can use factor loadings to construct portfolios that are tilted toward desired risk premia, rather than relying on a single, unreliable beta. What does this mean for investors? First, don't rely on beta for asset allocation. Second, use factor analysis to understand your portfolio's true risk exposures. Third, be aware that beta can change dramatically over time, so any beta-based strategy is fragile. Finally, remember that a high beta might just be luck, not a risk premium you're being compensated for. For example, instead of using beta to decide how much to invest in a stock, you could use its factor loadings to determine its contribution to your portfolio's overall factor exposure. This allows you to better control your risk and align your investments with your objectives. By moving away from beta, you can avoid the pitfalls of an unstable and imprecise measure. We've seen that beta is not the reliable measure of systemic risk that CAPM promised. It's unstable, imprecise, and often captures luck rather than risk. The shift to factor exposure is not just academic, it's a practical improvement for anyone serious about risk management. So next time you see a beta, ask, is this risk, or is this luck? We'd love to hear your thoughts on beta and factor investing. In conclusion, beta's limitations are well documented, and investors should be cautious about using it as a primary risk metric. By embracing factor models, you can gain a deeper understanding of your portfolio's risk and make more informed decisions. Thank you for watching, and we look forward to your feedback. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.